Good morning, everyone who is dialing in from across the world in this webinar today that we have titled as the Global Oil Markets, a New Normal. This is a webinar in partnership between Refinitiv and S&P Global Platts. We will give everyone a few seconds more, let's say 15, 20 more seconds, and then we will ensure that we can start with the presentation. Many people might be finishing off meetings and everything else, so it's always better to wait for a few seconds. So we'll give everyone 15 or 20 more seconds, and then we will go live. Great. I think it's 10:02 in London. Wherever you are in all corners of the world in different time zones, welcome again to this webinar jointly organized by Refinitiv and S&P Global Platts. To be fair, when we were organizing this about a few weeks ago, we were expecting turbulence in the oil markets. We were expecting noise, news, and everything that is happening. But the events in the last few days that have been happening, and I think it has added the importance of this webinar and having the experts come in and really have this interaction with all of you on the audience side. We are not going to kind of present too many slides or go into too much detail, but we will ensure that this is a lively interaction with all of you where you can plug in your questions and we can provide you with answers as well. So before I jump into any housekeepings or open up the floor as the discussion for everyone, I will be your moderator. I'm Rohan Shams. I'm the Global Head of Commodities Marketing at Refinitiv. And we are joined by three fabulous experts today who are going to be the real experts and the heroes on this webinar, providing you with all the details and answers. From S&P Global Platts, we have Daniel Clover. He's the Market Engagement Manager based out of Dubai. Daniel has been working with, I think, in Dubai since November 2018 and joined S&P Global Platts in 2008 in London. Daniel has been responsible for some of the company's major crude oil price assessments, including data Brent. He has also covered a variety of refined products assessments out of London. In 2012, Daniel moved out to Singapore and became the managing editor of the Asia Crude team, and in 2014 was appointed as the associate editorial director for the strategic oil markets developments. And from 2016 till his move to Dubai, he was the manager of the crude and residual fuel pricing and reporting teams in Singapore. Daniel also holds a bachelor's degree in science and political science from social and political studies from the University of Sheffield. So Daniel, welcome on the call. We'll definitely come to you with questions and engagements. We also have our Refinitiv experts, Ihsan Ul-Haq. He's the lead analyst on the oil research and forecast based out of London. He has around 25 years of experience in the crude and refined product marketing and pricing and fundamental analysis. He joined Refinitiv with us. He's been here since April 2018. He's been working on a variety of products and research around crude oil supply, oil stocks, prices, and also responsible for the oil flows and the fundamentals behind them that you obviously can access via Icon. Before joining Refinitiv, Ihsan worked for KBC Advanced Technologies. He's been with JBC Energy and with OMV in Vienna in Austria as well. So an oil veteran through and through, as we can call him. And obviously we have Captain Ranjit Raja, quite a familiar face on these webinars. You hear him quite often from our different webinars and podcast series that we organize. Ranjit is our oil and shipping research manager in Middle East and North Africa market with a primary focus on the oil flows and shipping data. His team formulates all the different research, insights, trade flow analytics, which really enable this real-time trading information and operational intelligence that you guys can access via Icon. And obviously, a big feature of it is the specialization in the vessel tracking element and the generation of big data for the midstream and downstream markets by the marine sector utilizing different algorithm and predictive modeling as well. Prior to Refinitiv, he was a master mariner, so an actual captain on the ships, and sailed throughout the world, hopefully in different shores in the whole world, with a fleet of tankers and working for different leading ship owners. So Ahsan and Ranjit, welcome to the webinar as well. And again, as I mentioned today, we will ensure that it is as interactive as possible for all of you. So you can use this feature of putting in questions where you can go in and provide any questions you want to ask to the experts as well, and then we can tackle. It is available as a Q&A tab at the bottom of your screens, so just the usual practice. Briefly about Refinitiv, you all know us as Refinitiv. We are the former financial and risk business of Thomson Reuters, and obviously we provide the fundamentals, data analysts, analysis, and the expertise to make important decisions and be on these market traders. So key discussion points, I think OPEC, changing dynamics in trade floats, tanker markets, bunker market, evolutions, impact of COVID, winners and losers in the price war. So there are going to be a number of important topics and themes that we are going to discuss today. But before that, I think something, Ranjit and Ahsan, I'll probably address this to you first before we go into Daniel discussion as well. The big news. Can you summarize on what we actually saw in the WTI market over the last couple of days? Are we really going to expect such massive volatility as an ongoing occurrence going forward, or was it just kind of a one-off activity? Ahsan, Ranjit, your thoughts first.
Hi, Rohan. Good morning. Hello, everyone. Good morning, good afternoon, depending on where you're joining us from. Thanks for logging into this webinar again. And so yeah, Rohan, just to address your point, so I think it's not a one single kind of a viewpoint or an answer that would determine or provide an insight into what we witnessed in the last couple of days. And like you mentioned, it's historic, it's unprecedented. So we're running short of adjectives to describe what we witnessed in the last couple of days. But what is, I think, more important is to try and understand why it happened, what happened, and also some of the reasons that goes behind it. So to primarily start with, it is purely a U.S.-specific issue that resulted in the huge negative pricing that we witnessed a couple of days ago. And it is not that the global prices are in the negative territory, which is mostly reliant on the Brent pricing, which at that point in time a couple of days ago was still above the $20 per barrel mark, and I think now it is down to around 17 or 17.5 as we speak now. And so going back to the U.S. Specific issue that we were talking about, and this in specific is mainly because of the huge storage crunch that we are starting to witness, especially for the May contract that was in place at that point in time. And primarily also because the delivery point for WTI is Cushing, and Cushing has been announced that they have absolutely run out of every single storage tank that could be let out or that could be given out for any kind of storage that could be used for. And the other reason is more on the financial side, which means most of or some of the investors who had potentially bought the contract initially thinking it's available for a very cheap price would have eventually been faced with a situation where they would have either had to sell out of it in order to buy the next contract, or to take a decision where they had to avoid taking delivery of the oil, because WTI is is usually settled with physical delivery, unlike Brent. And the infrastructure constraint, like we mentioned before, is one of the more pronounced reasons why, or rather one of the major driving forces that led to this massive shift in the market that we saw for a few days back as well. And the other side of it is also constitutes because of this whole COVID-19 situation that we are facing right now, which has eventually resulted in a huge demand destruction. There are U.S., from what we understand, has still not seen the peak of the whole cases that has been reported, and that has resulted in several major U.S. cities going into a travel ban or a huge consumption loss, both in terms of the refineries and the consumer demand that are expected in the market. And also what we need to understand is that this demand that we have seen being lost, or that demand that has reduced, is not going to jump back into what we were seeing before a pre-COVID situation whenever the economy starts to recover slowly. People are still going to be skeptical for the travel arrangements, and it's not people are going to be trying to compensate for the lost travel or for the lost holidays the moment it starts coming back, or the business travel as such. It's going to be more measured. It's going to be more strategic in terms of how businesses conduct themselves, and also for people who have unfortunately lost their jobs during this situation. It's not going to be an easy way back into the economy or easy way back into the job market, and that is going to be an elongated and a much more longer cycle before we can see demand resuming to levels what we were used to prior to this whole destruction that we saw happening. The next is actually looking at the forward curve in terms of the prices, which is usually a good indication of where things stand in the market. And if we look at the forward curve right now, it takes at least 4 to 5 months before it even starts to level off in terms of the pricing. And that is basically an indication that the storage is not expected to be made available at least until that point in time. And it is only after there is some kind of an indication for demand to start increasing after a few months that we can see the inventories that are kept in storage to start coming down, and which can thereafter be allocated for the new oil the new oil that is being produced or that is being imported into the country. So on the whole, this is purely an infrastructure-related issue. And talking about storage in Cushing, we can see how the volume has shifted just in the last few weeks, not even months. I think when we did the assessment in mid-March, the actual utilization of Cushing storage levels was just about 55%. And just in a span of a month, by mid-April, the inventory levels are expected to be somewhere in the range of about 70%. And this, of course, we saw a record inventory build of 19 million barrels that was reported a couple of weeks ago. And this week, for the last week, it is estimated that the inventory is again going to build by a whopping 13 million barrels, although the official numbers are expected to come out later today. And that is eventually going to be creating the crunch. And I think as per the estimate, with the way the inventories are building up, the expectation is that it's in a matter of 2 to 3 weeks, the inventory is going to build up to 85%. And we all know that the official estimate for Cushing storage is somewhere in the range of 76 million barrels. And keeping some other level of safe limits, we are going to be reaching to the brim very, very soon, if not later. I guess maybe Ehsan could add a little bit more. Yeah.
Hello, everybody. Just 2 points, 2 questions which are being asked at present. The first question is what would happen to the June contract when it expires in the 3rd week of May? Because storages are being filled, and as far as Cushing is concerned, total storage is around 78 million barrels, and we already have more than 55-60 million barrels at present. So, and they are increasing at a rate of around 5 million barrels every week. So storage will be filled soon. So as a result, there will be even more pressure because of logistics, as Ranjit pointed out. As a result, it could happen. Yes, it could be repeated when the June contract expires. And then the next question is whether it can happen to Brent. So Brent is cash settled compared to WTI, where you can get physical delivery. As a result, probably it cannot happen with Brent. On the other hand, we also have seen some even seaborne crudes being being sold at negative prices, so some Latin American prices being sold at negative prices. Also WTI being offered at a $7-8 discount to WTI. So as a result, it's uncharted territory, but I think Brent will not have such a fate, and I think we will continue to see positive prices as far as Brent is concerned.
Very interesting, Ihsan. And I think one quick question, Ihsan, I can see somebody is asking, and you mentioned earlier about the maximum level available in Cushing. You mentioned it's filling up at 5 million barrels per week, but what is your estimate of the maximum levels of storage available?
According to the EIA, we have total storage of around 78 million barrels in Cushing, although we need some operational capacity in order to operate these storages. As a result, it will be difficult to fill it to the brim. So as a result, probably in 2 to 3 weeks from now, the storage is likely to be full. And then there are also a number of questions whether WTI is a good benchmark, whether Cushing is the right place as a delivery point. I think oil exchanges will also be thinking about it, and they have always come up with some solution, and they will also find solution to problems we are facing at present. But the total capacity in Cushing is at around 78 million barrels.
Interesting. And that is the full disclosed one. But as you mentioned, operationally, it might be difficult just to fill it to the full brim. That's very great. I think, Ranjit and Ihsan, it's really good insight. Daniel, just to bring you into the discussion as well, and I think a major impact is this supply-demand imbalance and the kind of the whole scenario that is playing out in the wider world as well. And specifically around Saudi Arabia, and we know the OPEC agreement that was reached by apparent intervention by Mr. Trump as well in some case. But Daniel, sticking to the official selling prices in Saudi Arabia, because they decide to a certain degree about the impact on the wider world, what do you see as the kind of latest OSPs trend in Saudi Arabia, especially the delivery out to the Asian markets? Do we expect the OSPs to continue their downward trend for the next month, or do we see a different picture emerging?
Thanks, Rohan. So the official selling prices to Asia come out once a month, and what we saw and really was very widely anticipated by the market was the emergence of the May OSPs earlier this month, because what we had was that OPEC Plus agreement, and then it was all eyes on what Saudi Arabia's next move. And ultimately, the cut that was implemented to Asia was greater than the traders expected. So the typical formula that traders look at in this market is the spread between the cash Dubai and the Dubai derivative spread. And that really just shows the relative strength, or ultimately in this scenario, weakness of the market. And that fell just over $3 a barrel month on month. But what we saw for the main export grades, and Arab Light in particular, which is really the flagship that everyone is looking at, fell $4.20. So while the market expected maybe a $1 to $3, there were some analysts that said actually they expected no cut to be implemented because of the OPEC Plus agreement, that maybe there would be a signal from Saudi Arabia that a tightening of the market was on the cards. But actually what we saw was that $4.20 cut to Arab Light. And that the market really interpreted as Saudi Arabia not willing to lose market share in Asia. Ultimately, right now, demand destruction is there, and the producers are looking to not lose customers as much as they can. So, one way you try not to lose customers is to be the cheapest one out there. And that's in turn really put pressure on other producers, because they are also then incentivized to cut their own OSPs as well to remain competitive. So it's a bit of a, not sure if it's fair to say race to the bottom, but you have to cut as much as your nearest rival to remain competitive. So the pressure has really been on producers in the Middle East and also from further afield as well, because if you want to compete with long-haul crudes in this scenario, long-haul crudes, which the freight is going to cost more. There is a contango, so that can cover maybe some of it. But ultimately, you have to be competitive in this market. And what we've seen, going back to what we've just heard about WTI, admittedly, we haven't seen any negative territory for other grades, maybe Brent or the Dubais, but the pressure that has been put on WTI has now really rolled into the June contract. We can see that on WTI, and that in turn has been putting pressure on the international benchmarks. So with the question of do we expect the OSPs to continue their downtrend next month, certainly the market structure that was first mentioned, so that cut or that fall to the market structure that we saw in March actually has only increased through this month. So month to date in April, the spread really between cash Dubai and Dubai derivatives has fallen to average $9.70, and that's compared to minus that 311 in March. So that's a fall. So the market structure has ultimately fallen over $6 a barrel. So the market expects the Arab Light OSP to be cut further. And there's really questions around, will that happen? Will it be cut to by that $6? Because we've had 2 months of OSP cuts that have taken the prices $10 a barrel lower. And we're now in an environment of OPEC cuts. But then the question is, if Saudi Arabia do not cut, then their competitors cut a little bit, then their competitors will be able to sort of undercut them. And also the price of transporting the fuel or the crude has risen as well. So you need those discounts to rise, greater discounts to counter that higher cost of transportation.
Understood. No, that's really helpful, Daniel. I think that's a comprehensive answer. And I think sticking to this Saudi OSPs and the impact it will have on the market, and Ranjit, probably to bring you into this element as well and expand the discussion, as there was a recent OPEC Plus agreement that was kind of renegotiated. So let's combine, and I can see a number of questions coming in. So we will address all the questions, guys, just to ensure that we can bring in a bit of consistency here on answers as well. But Ranjit, can you talk us through the recent OPEC Plus agreement, and what do you expect going forward as an outcome of that agreement? Are we expecting any increase in supply and storage? And I think if we also roll in 2 other questions, Ranjit, that we've received on the webinar so far. One, the impact of this agreement on the wider OPEC economies in the region. And 2, also, I think there was an element of the Cushing storage, as in, is it a really centralized global impact that will have on the storage, or is it a more regionalized play? So if you want to speak about overall OPEC agreement, impact on the economies, and the storage element to it as well, I think that should be quite helpful.
Yeah, sure, Rohan. So anyway, to start with the first part of the question, which is more around the OPEC agreement of what was decided earlier this month. So this, the slide that you're seeing on the screen is more or less a summary of what was decided. And before going into detail on this, one thing that, or rather before even going into the whole discussion on oversupply and storage, there are a few things that we need to kind of lay it out for, so that there's a clear understanding in terms of where things stand. So to give it in brief, there are 3 phases in which the whole production agreement has been put in place. The first one is expected to start from next month, or the month of May and June. And that is the first cut that has been announced, that it is going to be in the range of 9.7 million barrels per day from OPEC Plus. The second phase is for the second half of the year for about 7.7 million barrels per day. And the third last phase is from Jan 2021 to all the way to April 2022 for about 5.8 million barrels per day. And I suppose that is subject to review in December 2021. And so the most important thing that we need to factor in here is the baseline that is being used, which is the October 2018 levels. And why this is important is because if you look at the current production levels, which is either March or for that matter, even the average of Q1 2020 that we are seeing, we are somewhere in the range of about 28.4 million barrels per day. But whereas the October 2018 baseline number is starting from 32.6, which means the start of the cut that is being planned has been pushed about 4.25 million barrels up than from the current production levels, to even decide on where or how much oil needs to be taken out of the supply equation. And that is the first issue or the trouble that we find here, because although the overall expectation is about 9.7 million barrels per day from the whole OPEC Plus group, if we look at the OPEC share of the whole agreement, that is expected to be somewhere about 6.1 million barrels per day. But if we actually translate that into the current production levels instead of October 18 production levels, then we are looking at a maximum cut of only about 4 million barrels and not the 6.1, which is roughly about 35% lower than what the announced cuts are. So we understand, okay, the baseline has been agreed for October 2018, but what matters is what is the total oil output that is happening right now, and what is the oil supply that is available to the market right now. So if we translate the numbers into the current situation, we are still lower than what is being actually promised in terms of the overall supply that is going to be made available to the market. The next is the problem is more about the compliance. So we are talking about a cut that is almost 4 or 5-fold than what the countries are usually used to before this, and which essentially brings the whole question down into who's going to be promising or how much of the agreed cut is going to be actually complied with or actually being enforced in terms of what the output is going to be. Okay, we are seeing a lot of headlines today where the instructions have been passed by the Russian government to reduce their state producers, the local producers to reduce output by 20%. Kuwait and UAE are also putting their systems in place. But it is always about the other, what exactly is going to be the total resultant output from all the countries combined that we can see getting pushed into the market when the enforcement actually, or when the production cut agreement actually comes into play. So the next part is, again, the agreement was agreed in the start of April, and the cuts were expected to start from start of May, which means there is almost 1 month of supply, or 1 month of supply where everybody is trying to push as much of volume into the market at this current point in time, where the demand is already down by 30 million barrels per day. So if we look at pure numbers, we are talking about a 30 million barrels per day drop in terms of demand for at least a month, if not more. And we are talking about the cut, which is essentially about 10 million barrels per day, including the OPEC, the non-OPEC plus members. Say, even if it goes up to 15 million barrels per day, there is still an oversupply of a good 15 million. And that doesn't even take into factor or account the amount of volume that is being kept in storage at this point in time. So like we said, the Cushing is just one aspect of it. It's just the U.S.-centric hub. But in order to get an overview of the overall global storage, we also need to take into factor how the major economies are saturated in terms of the storage levels. And of course, Daniel touched upon how the tankers are also being used in terms of using them as storing the volumes and the volume of oil. So we also need to take a look at the floating storage levels. So the first thing to start with actually taking a look at how the contango structure has been shaping up. So if you look at the M1, M2 spread or the M1, M6 spread, the massive contango that exists right now is a huge incentive for traders who want to take a position right now with the expectation that the price is going to go up a few months down the line. And like you mentioned, a couple of options that exist for them is basically to store the oil right now, which again puts it into a question of where they want to store it, whether are they going to have access to one of the shores or the onshore storage facilities, which is under massive pressure right now. And as we know, if the level of storage or the level of available tanks is dropping, then the price for the remaining available tanks are going to be enormous, which essentially means is the contango structure, or is the contango even going to be making up for the cost of storage that these traders are going to be having an impact for. And if you look at just the floating storage part of it, we are looking at a sharp increase just with the sheer number of tankers that have been booked just over the last month in terms of volumes that are expected to be put on board. So we are expecting just in terms of VLCCs alone, the floating storage to go up to almost 120 million barrels by the end of April. And this is not taking into factor the Suezmaxes and the other smaller tankers, which could also be potentially put into place. And According to some estimates, the total storage is expected to reach almost 160 million barrels in some cases, where that's the offshore or the floating storage volumes that are going to be made available as well. So all these parcels need to find a home somewhere when the demand eventually picks up. And this is a snapshot of the global onshore storage levels at this point in time. So almost pretty much all major economies, especially the Asian demand centers, are somewhere in the range of 60 to 65% that's being filled at this point in time. But what is important is also to understand how much of the remaining free space is actually available for either renting for the storage or taking it for a new hire for the people to put their oil in. So that is going to be the key question, and that is what is actually causing this huge impact in terms of the disruption between the whole supply and demand. Just to touch upon the economy side of things among the OPEC countries. So yes, the OPEC agreement has been put in place. Every member of OPEC needs to contribute their share of the cut, which I think for the first phase is going to be roughly about 23%, and then reducing to 18%, and then followed by 14%. But what remains unanswered is specifically for the African members of the OPEC group. These countries are heavily reliant on the oil revenue as a substantial part of their fiscal budget. And what is going to happen is the moment their revenue are going to be impacted extremely, both in terms of a reduction in volume, because the heavyweights like Saudi, Russia, they are gaining more market share by dropping their prices as much as possible, and which will definitely not be able to be compensated or be able to be fought out by the smaller OPEC members in the group. And the second one is also because of the low prices, the lower revenue that they're going to get for the smaller volume that they eventually manage to ship out. So this is eventually going to lead into a long-term impact in terms of the new productions on the new investments that are going to go into each of these countries, which are going to be taking a back step from an oil major's perspective in terms of potential investments that they would want to make in the current environment that exists. So these are the various moving targets right now, which are going to have a huge impact and also a huge challenge in terms of the longevity of the whole agreement that has been reached and how the supply-demand balance is going to be brought in place.
Brilliant. That's really helpful and comprehensive, Ranjit. And I think connected to that, then coming back to you, Daniel and Ehsan, about the oil inventories. So do you guys have a view on how have the oil inventories shaped up in the lead up to and since the market collapse as well? So Daniel, probably you can start from a Middle East perspective, and Ehsan, then we can move into the European and US perspective as well. So Daniel, do you want to speak about the oil inventories?
Thanks. Yeah, I think within the Middle East, the most transparency that we see is in Fujairah in terms of sort of commercial stockpiles. And we see weekly stocks coming out of there. And we saw a record 15.5 million barrels of residual fuel in storage in Fujairah earlier this month. And overall, Fujairah has about 60 million barrels of crude and refined product storage, with about a 20 million to 40 million split of crude to products. And while those residual stocks have risen in recent weeks, hitting that record, what's really critical is there's no available tanks for rental. So overall product storage, you need a certain amount, as we heard earlier, for throughput, for operational. And within Fujairah, you have bunker sales, so certain amounts of those tanks will be used for bunker sales. And the availability is the key, and it's just not there right now. If you picked up the phone to speak to any of the terminal operators within Fujairah, they do not have a tank available for you for rent. So the commitment has been made. So you won't always necessarily see it in those stocks week in, week out, which are very high. But in terms of is it available, it's just not available right now for you. So within the Middle East, we have seen a rise in oil being stored. The crude, we understand, is full as well. So it's not there, and it's not easy to just build a tank. So people are now looking at that floating storage for refined products, looking at taking on long-range tankers, VLCCs, and just anywhere that you can try and store products. Because just demand isn't there. These are transportation fuels, and we, as humanity, are not moving around the world as much as we used to, be it in cars, buses, aeroplanes. So the refined oil has to go somewhere, and it really is struggling to find a home in the end users, and it's struggling to find a home in landed storage tanks because they filled up.
Interesting. Hassan, do you want to add European and U.S. perspective?
Yes, just adding to that, as far as the U.S. is concerned, U.S. crude stocks, commercial stocks are now above 500 million barrels, and they continue to grow. And if Cushing is full, then probably the rest of the country will also gradually start filling up, and probably, last week we saw a historic increase in crude stocks in the U.S. And if API data is a clue, we will see another build. We saw another build last week, and it's increasing at more than 10 million barrels per day, at 10 million barrels every week. And same is the case in the European Union. We don't have data for April. March was still okay as far as coronavirus is concerned. We still saw, European Union, EU 16 crude stocks increasing to almost to 485 million barrels. And in April, because refinery runs were cut, as a result, they will continue to grow. Daniel has a slide about world refining capacity and how much of it has been cut. If we look at it, if U.S. is the clue, in the U.S. refinery runs have gone down by almost 6 million barrels per day, and if we add then Europe, if we add Asia, refinery runs are down by around 13 to 18 million barrels per day, and this crude has to go somewhere. And if refiners don't want it, then probably it will result in storages gradually filling up, and once you don't have anything left onshore, then some of it will go to offshore. And I read a story from OPEC. OPEC said, OPEC is one of the key storage companies. They said that all their storages are fully committed. So as a result, as long as the virus continues to have impact on demand, storages are likely to be filled, and production cuts they will certainly result in some decrease, but they have come too late and probably too little. Let's see what happens. At present, it looks gloomy as far as storages are concerned. They will be full soon, and probably have negative impact on prices.
Great. Thanks a lot, Hassan. And I think it was a really key comment, Daniel, you made about humanity not moving at the moment. So I think it is fair to say that the storage arms are going to see a bit of pressure in the coming weeks. But Hassan, connected to that discussion, and if we take it slightly different perspective, what kind of changes are we expecting or kind of already witnessing on the global trade flows under the current circumstances, and especially with the impact of the COVID thing that we've had?
As far as Europe is concerned, what we have seen in April is that more and more crude is coming to the Mediterranean via City Creek, via directly from the Middle East. So the Mediterranean is facing a large supply because of increases before the production cut agreement was agreed upon, and as a result, as far as the Mediterranean is concerned, probably we will continue to see increased supplies in the next few, at least 1 or 2 weeks. As far as Northwest European market is concerned, probably Middle Eastern producer have left everything to Russia. So we haven't seen too much increases as far as supplies from the Middle East are concerned, although the U.S. has become a key player. I mean, the only country which has been getting increased numbers of volumes from the Middle East is Poland. Poland has been trying to diversify its crude slate. As a result, they are buying a lot of Middle Eastern crude, but otherwise, Middle East crude has not impacted the Northwest European market. So, I mean, it's also very much dependent on prices. If we look at Dubai, which Dubai is at a premium of around $6. If we look at Brent Dubai EFS, it's minus, which means Dubai is at around $6 premium to Brent. As a result, I mean, it makes more sense to send more to Asia, and with China recovering, probably Middle Eastern players find China interesting, and China is also increasing its strategic reserve. India is also trying to increase its strategic reserve. And according to some, OPEC plus officials, they said that up to 200 million barrels can be added to strategic reserve. President Trump is interested in increasing, giving the opportunity to oil producers in the U.S. to send some of their barrels to strategic reserve. Also India, then China, and so as a whole, whether it's 200 million can be added, it remains to be seen. But probably we can have at least more than 100 million barrels being added to strategic reserves in the next 2 months, I think.
Interesting. It is time to build those reserves. I think it's a pattern that we are seeing all across. That's understandable. And Daniel, coming back to you, and I think Hassan made a mention of the refinery run cuts. So in your view, what kind of refinery run cuts are we seeing globally impacting the crude demand at the moment? Do you have some thoughts and ideas on that?
Yeah, so Platts Analytics, which is our analytics arm, they expect to actually see a new peak level of global refinery downtime of 19.3 million barrels a day for the week ending this week. So, and that's the revision up. We can see that earlier this month, there was a view that expected fall in all of demand in April and May was 16 million barrels a day. But actually, we then expect this downtime to remain at this level for next week as well. So the list is just growing and growing. The US, Europe, Asia, now Latin America. It's also hard, once people look to bring in those maintenance teams, they're not actually able to. So one way to delay the shutdown, a total shutdown, is to do some maintenance. But the issue is that some people aren't able to get the maintenance teams to where they need to be. So there's some issues around that, because once you fall below a certain amount of operating level, refiners don't really want to do that, because turning the refinery off is not just a case of turning a switch on and off. So it's probably a reluctant measure, but people are looking to reduce those throughputs as much as they can. So sort of just a view of throttling down as much as you can effectively.
Understood. And I think, this is a long topic of this shutdown and turnaround of refineries, because I think it's been in discussion in the industry for a while. And obviously, I think the challenges are coming to the fore in the current scenario. So I think we do have a number of questions that have come in from the audience as well. I think it's going beyond 35 questions already. So what we can try and do, and obviously we can address as many as we can within the time slot we have. And if your question remains unanswered, then what we will try is to reach out to you individually and provide you with an answer as well. But in the meantime, there are a number of resources available as well. If you might see within your webinar tabs that you can download a number of special research reports from Refinitiv. There are some reports from our S&P Global Platts partners. So please do make use and the kind of best of those resources available to you as well. But turning to the audience questions as well, guys, and I think one, Ehsan, probably for you is that how do you explain the enormous differential between the spot dated prices and futures? Does it reflect the optimistic expectations of the traders, or are there any other reasons for that? So this question is about the differential between spot and futures.
Rohan, these are two different markets. I mean, dated Brent represents physical market, and futures market is also governed by financial players. And there's also a different time period. I mean, Daniel has been doing, as I know, Brent assessment. So as far as the physical market is concerned, dated Brent is about 10 to 30 days market. So what is happening in the next 10 to 30 days. And the futures market, on the other hand, doesn't have a similar contract. So as a result, futures market is different. And because increasing storage is, they are creating problems for the physical market. As a result, dated Brent has been impacted more than futures market, and it has the futures market has been supported by financial players, but it also has impact for some official selling prices. We were talking about official selling prices previously. If we look at Saudi Arabia's OSPs to Europe are at a differential to the ICE Brent contract, and as far as Iraqi OSPs are concerned, they are against dated Brent. And if we look at, for example, Arab Light to Northwest Europe, Saudi Arabia didn't change anything, so it remains at a 10.25 discount to the ICE Brent contract. But as far as Basra Light to Europe is concerned, it was revised down from a discount of 8.80 to 8.30. And because dated Brent is at a huge discount to futures, so as a result, Iraqi crude has become very, very cheap. And I mean, if we look at flows, a lot of Basra Light is coming to Europe. Some flows which were intended for India were diverted to Europe. So, I mean, if your OSP is against dated Brent, then prices are relatively low, and people will prefer that. And because Saudi Arabia shifted from the B wave to ICE Brent, and as a result, I mean, they cannot adjust their OSPs, benchmarks in a short period. So as a result, their prices are relatively high compared to dated Brent. This is the impact. So I think at the end of the month, because dated Brent is about 10 to 30 days ahead. So as a result, at the end of the month, they come together. So at the end of the month, both of them are very near. But otherwise, I think this spread is also being governed by the contango structure, and we will continue to see that at least in the foreseeable future.
Understood. Yeah. And I think, Daniel, there's a question about the OSP as well, so probably the something that you can address. And it goes by as considering all factors, how much AL OSP, Arab Light, I reckon, cut versus May would you expect?
Thanks. Well, I think it's not so much my expectation. I think it's the market's expectation from a sort of a trader standpoint. I think there is some wiggle room on the Saudi side, because if they have been cutting more than the market expected in the last couple of months by about $4 more than was expected in the month of March, and that was when those April OSPs came out, and then that extra dollar more that came out in April for May. then there's $5 that they've cut more than the market expected. So maybe they don't cut that full $6. Maybe they use that sort of slack that they gave themselves by cutting more than the market expected to not cut as steeply as the market might expect next month, because there is a surplus of crude to the market right now. So there comes a point, as we saw really with the WTI, where you can even get to a position where you are giving oil away, and that's certainly a situation that producers don't want to be in. It's not going to cover their cost of production. It's not going to help rebalance their budget. So they do have an ability to adjust the prices using those differentials, and I think the market won't expect such a steep cut for the third month running, particularly as we should be then in an OPEC cut scenario, because these will be the June official selling prices. But this is how far forward the market trades, right? We are moving into, right now we are trading June loading barrels. Next month we will see the June OSP. These barrels are not going to be refined, if they do get refined in a typical trading cycle, till at least July or August. Yet we've had a build-up over the last few months of barrels that haven't been consumed. So it's really just adding, right? We're just adding to the inventory, we're adding to the surplus, and there has to come a point that this either ends or we do move into some really, really low numbers, not just in the US, but also in other grades.
Interesting. No, that's definitely helpful. Ranjit, probably a question for you, and I'm reading through all the number of audience questions that we receive, and please do keep them coming in if you would like to address something. But this one, again, what Daniel was referring to, the status price on the WTI benchmark. What options do the U.S. have to support WTI prices in the short form? Ranjit?
Yeah, so a couple of options right now, because like we discussed earlier, I think right now it is more, or rather the issue that is facing in and around WTI is purely and more pronounced due to the infrastructure around there. So unless otherwise the volume is being factored into some kind of a storage option, it is going to be extremely difficult for bringing the WTI, providing any kind of support for WTI. So the major factor, the major way to bring it under control is purely by a production cut, which, of course, like we have seen all this while, it has been more around that U.S. cannot command or determine how much individual producers need to cut from their end of in terms of cycle. But on the other side, if there comes a point where, like Daniel mentioned, if the prices are negative and if they are ending up giving the barrels away for free, then it's not sustainable as well. So the production cut is going to be coming in some form or the other. The only way out is for some kind of an intervention from the U.S. government in terms of bailout, in terms of the companies that are not able to sustain themselves. Or the other option is actually to pay the company, instead of paying them for the bailout, is to actually pay them for keeping the oil in the ground. So, which essentially would mean that it's kind of a win-win for both the producers and the government. So instead of the oil coming out and then looking for a storage elsewhere, then there will be a determined or a contracted volume for the U.S. government to use those volumes as a strategic storage reserve and asking the companies to be left where they are right now. And that could be used as a commitment for the producer to sell the contracted volumes at a later date when the U.S. government is able to find an appropriate storage facility for them, and at the same time also having helped the producers to pass through this current situation in terms of getting out of the financial deadlock that they are being faced at this point in time.
Understood. Many thanks, Ranjit. I think, good comprehensive answer. Ehsan, probably a tricky one for you, and it's demand related on the product side. How much do you see the impact of demand on diesel due to COVID-19, and is the run cuts good enough to counter it? Ehsan, do you have a view?
Yes. As far as diesel is concerned, compared to other refined products, trucking demand has thrown a lifeline to ailing refineries because if you have to ask Amazon, you have to ask some other retailers. I mean, they have been. If we look at these companies, they have been transporting a lot of goods in order to provide household items to consumers. So as a result, diesel demand has gone down, but not too much. For example, if we look at a diesel demand in 2020, 27 million barrels per day or 28 million barrels per day. I mean, there are different estimates that demand will go down this year by 5 to 8%, but it's still less compared to other products. If we look at gasoline, while diesel demand will be down by around probably diesel demand will be down by something around 2 million barrels per day, but gasoline demand could be down by 3.5 to 4.5 million barrels per day for the whole year. These are present expectations, although it might change over time. So diesel has been helped by companies such as Amazon transporting a lot of material, and I think European refiners are better positioned to profit from it because most European refineries produce more diesel than gasoline compared to their U.S. counterparts who maximize gasoline production. So gasoline demand is down, but not as much as the rest. So compared to gasoline, even jet demand has been impacted significantly, but I think diesel demand has not been impacted. But it will still take several years to get back to levels we saw in previous year. I mean, in 2020. Probably demand has gone to levels below 2013 levels as far as diesel is concerned, but probably if things improve next year, we will be back to at least to 2019 levels. So there is still some hope for diesel.
Brilliant. Thank you very much, Hassan. I think a good comprehensive one. And I know we are short on time, so we are in the last 2 minutes. So as I mentioned, we'll reach out to all the individual questions we received from the audience. But just to throw this question to each one of you, and probably I would say a 30-second answer from each one of you. Who will be the winner and who will be the loser of this current price war? Ranjit, do you want to go first?
Yeah, sure, I can. That's more like $1 million question right now in terms of finding where things are going to stand. So I think from where things are standing, the one factor that determines anyone's future going ahead is going to be the extent to which we are able to find a solution for the current pandemic that's going around. And I think that is by far the biggest X factor in the whole equation between supply and demand at this point in time. And unless otherwise we are able to find a proper resolution for that, we cannot expect demand to come back into the levels that would be needed to keep the supply going forward in terms of the levels that they are in right now. So it doesn't matter if we choose to cut 10 million barrels or even 20 million barrels, it's still going to be an oversupply considering the amount of volume or the volume of oil that's floating around both in the onshore and the offshore storages. And even for that to be consumed, it's going to be a few months or maybe even years before we can see any form of normal resumption at this point in time. So at this point in time, I can't see a clear winner or loser in the industry for now.
Daniel, what do you say?
Yeah, I would echo that, really. I think that, there's maybe arguably bigger factors at play, and the market and the world is looking for those solutions because even with the price where it is, the traditional consumer is not able to take advantage of those lower prices right now. So they are not winning as it would be seen right now.
Hassan? Do you have a view?
I agree. I mean, there are number of users, but I mean, consumers cannot avail. I mean, the prices are down, gasoline prices are down, but they cannot travel. So as a result, I mean, there are a lot of losers. Even countries which were interested in increasing production a few weeks ago, they are losing a lot of money. They cannot work on their social service projects. So, I mean, U.S. producers are losing, Saudi Arabia, Russia. So there are many losers. So only a few winners if consumers can avail themselves of the opportunity to travel a bit.
Understood. As we call them, a lot of unknowns in that scenario. So I do appreciate Hassan, Ranjit, and Daniel, your time. I know we've overrun by a minute, but really helpful insights, good interaction. We will definitely provide the recording and the associated assets that are available as presentation decks and all the other bits that are available for download. So thank you again, everyone, for joining in. If you would like to know more about the services available via Refinitiv and the content and data from S&P Global Platts that you can access via Refinitiv, please do indicate it in the survey that will pop up at the end of this webinar, and one of our specialists will reach out to you. The recording answers to any specific questions we haven't answered and all the other resources that were available. We will reach back to you over emails with all of that detail. So again, until we speak again and share more insights, till then, goodbye and thank you.
Thank you.